Hi, Bishop. Shall I start?
Yeah, so we are live, so you can start.
All right. So, good evening, everyone. Uh, Welcome to today's masterclass from Skillage on finance. Thanks for joining us today. I'm Shailendra Marathe. I'm a co-founder and CFO of Skillage. Last week, you heard Ankit, who is one of the lead faculty for us in the finance domain, with extensive experience in industry as well as with the qualification of a chartered accountant and teaching. So today I'm going to talk about one of the basic concepts, in finance, which is extremely important, right? So though it's a very basic concept, it's very important that we understand this concept thoroughly and very well. In any area of finance that you are in, for example, you could be, working in, let's say, accounting. You could be working on financial reporting. You could be, working on sort of investment decisions, right? Or you could be working on budgeting. One important concept in finance that you must understand extremely well is the concept of time value of money, right? So that is the concept that we must understand very well. And today, for next about 15 minutes to 20 minutes, I'm going to talk about this concept. I'll give you some examples also while explaining this concept, and then if you have any questions on that concept, I'll be happy to answer those. Right. So that's what today's session is going to be about. So what exactly is time value of money? Right. So we understand that money has a value. Right. The reason money was invented is that the barter system, which basically involved exchange of one type of goods for another. Let's say exchange of cotton for, let's say, some type of crop, right? Crop seeds, or for metal, which was there prevalent for ages with humankind, which facilitated, let's say, trade between various continents, between Europe, America, Africa, Asia, right? Barter exchange, it had certain kind of limitations or difficulties. The barter exchange slowly, because of the limitations, gave way to something where people started finding some kind of a common measure of money in gold, right? So gold was one of the commodities which was discovered some time back, and it's an, what we call a precious metal, right? So gold, silver, platinum, uranium, these are precious metals. And then there are other metals like iron, etc., right? So gold was considered as a basis in which we can transact with the world. So for example, we know in India, for example, gold coins have been there for quite some time, right? So I mean, probably over 1,000 years or so, and in many other countries also. Gold, silver, these coins became very popular. And if I had to buy, let's say, something from Middle East, I had to buy something from, let's say, Africa, or let's say Europe, right? Then we sort of, argued and settled the price in terms of, let's say, 5 ounces of gold, right? So weight of gold and the purity, right? With this, some kind of a mechanism for exchanging goods, for trading between, various partners was worked out. So that was, one intermediary step in the evolution of the currencies. That's again money, right? This evolved into something called a gold standard, right? So there was a sort of agreement between, various countries that, this amount of gold means, so much of wheat, so much of sugar, so much of, whatever metal, and so on and so forth. Around, World War II, and, around that kind of a time frame, then there was a thinking around, gold and the difficulties involved in valuing gold. Some countries were producing gold, the others had to buy it. For example, India has been a big buyer of gold for probably a millennia or more, right? So today, the household gold reserves in India, the household gold reserves, I'm not talking of industrial and the government gold reserves, they are probably the biggest in the world, right? Or probably bigger than the entire world combined. Household, I'm talking about. Because in our culture, the gold has got a specific significance, right? So we have been accumulating gold for a very long time. So there was a discussion around, evolving something else beyond gold, right? So that's where the paper money came in. right? So paper as a medium of exchange, it came in. And then again, we have our own currency, which is Indian rupee. Bangladesh has taka, Pakistan has Pakistan rupee. In this continent, then in China we have, for example, yuan, right? So that is the major, and so on and so forth. Now this is within this subcontinent. In Singapore they have Singapore dollars. In Malaysia they have something else, ringgit. Then in UK they have British pound. In UK itself they have, for example, British pound, Scottish pound, and there are Channel Islands which print their own currency. But how they have managed this, they defined exchange rate as 1:1, right? So that currency works broadly, everywhere across the entire United Kingdom. And then US has US dollars, Canada has Canadian dollars, right? So that's how basically every country or nation, they started printing their own currency. So there was a delinkage from gold, right? So gold was not required anymore. So initially the thought process was, if I have 200 tons of gold and it's valued so much, then I only issue so much of currency. But slowly that, with the Keynesian economic model and the deficit financing and, government spending more than what government is earning in order to, get into supply creating own demand kind of a situation, in that whole new economic concept, the paper currency became extremely important. And then we had the what I would call, again, it's a digital currency. Again, digital currency today is being talked in a different context, but we had digital currency. The banks, the IT systems came up around 50s, 60s, and then we were transacting through the banks, right, using IT systems. Today, for example, most of us hold very small amount of currency. Somebody who, let's say, draws a 2 lakh rupees salary, for an example, right? So every month you might just hold about 20,000-30,000 rupees currency at any point in time. It doesn't need more currency. You might withdraw 20,000 in a month, to pay for miscellaneous expenses. The rest of his money is with the bank, right? And the bank holds the currency on his behalf. So that's how the system works. Now that is fundamentally the concept of money. Now new concepts are again coming up. As I said, a new kind of digital currency which is issued by a country, that's coming up. RBI and government of India is talking about it, sort of, to give a competition to cryptocurrency, because bitcoins and others, the algorithm based currencies have come up in last about 10 years. And some people are advocating that they are a better store of value as compared to the sovereign currencies like USD, CAD, and SGD and INR, etc. That's what is happening. So that's fundamentally the concept. Now, as we can see, within a country also, let's take a very simple example. If, let's say, I want to sell my car, right, and it's a second-hand car, some car which is getting sold, let's say, at approximately 3 lakh rupees today after 5 years, right? Let's take that as a basic concept. Now I want to sell that car and I want to get the cash. And let's say I'm not in a hurry to, I don't need that cash per se. I'm buying another car, so I'm selling that. If I need the car cash immediately, then of course only the person who gives me cash immediately is going to matter to us. But let's take that equation out. Now I have two buyers who are willing to buy the car from me. One buyer says, Shailendra, I'm willing to give you, let's say, 2,75,000 today cash meaning maybe check, which will get in cash, right? So cash may not be actual cash, but it's like a cash transaction. The other one says, Shailendra, I think, yeah, you're saying you want 3 lakhs, I'm willing to give you, but then I'll give you a check which you can bank exactly 1 year from now. So today is 17th of April 2022. You bank this check on 17th of April 2023, and I promise you it will get clear. So you'll get 3 lakh rupees on 17th of April 2023. Versus the other guy is giving me check which I can put in tomorrow and it will get cleared in the bank, which is 2,75,000. Now, here comes the question. I anyway don't need the cash immediately. I'm selling, but I don't need it. I mean, if I need it, obviously the answer is very simple. I'll take 2,75,000 that I'm getting and I'll settle that deal, right? But let's get beyond that and look at, which is the better deal for me. Somebody giving me 3 lakh rupees a year down the line is better deal, or somebody giving me 2,75,000 rupees today is a better deal for me. The difference between these two transactions is the same car, I'm selling it off. I'm not worried about check getting encash. So let's take that also out of equation. I'm not worried, both are known to me and they have got money and all that thing. So don't worry about, wo ek saal ke baad check clear hua ki nahi. Let's take that equation out just for the sake of understanding the concept. Of course, I mean, getting money today is better than getting money tomorrow. You don't know whether that check will get encashed tomorrow, but let's take that equation. I'm confident the check will get cleared a year down the line as well. Now, which is the deal that I should ideally opt for? How do we decide? I should go for buyer A who's giving me 2.75 lakhs versus buyer B who's giving me 3 lakh of rupees. And that is the question before us. This brings us to the concept of something called the time value of money. In these two transactions, the buyer is different, of course, right? And what is different is the amount, of course. And the third thing is the time at which I am going to get the money from the buyer. These three things are different. And my decision will depend on how I look at, how I value the money of 2,75,000 today as against 3 lakh rupees received exactly 1 year from now. If 3 lakh rupees received 1 year from now, it looks more valuable to me. On the face of it, 3 lakh rupees is more than 2.75. But remember, I'm going to get it back after a year. If this 3 lakh rupees looks more valuable to me, I will go for the buyer B. But for me, if this 2.75 lakhs today is more valuable than 3 lakh rupees a year down the line, then I'll go for buyer A and I'll get 2,75,000 rupees from him and I'll be happy. I'll close the deal at that point in time. Here is when I'm trying to sort of derive the time value of money. I'm trying to equate both of these and come to a decision. But these are not same. 3 lakhs rupees is 1 year down the line and 2.75 lakhs is today. So how do I take the decision? Correct? Typically, if I don't need the money today, put yourself in my shoes, right? What am I going to do with that money? 1 year is too less and 3 lakh rupees is too small amount or 2.75 to put in a house, right? I can't buy a house in 2.75 lakhs. The transaction costs are very high, stamp duty, etc. Selling, finding wire is difficult and all that. So of course, I can't invest it in a house. I can invest it in, let's say, bonds. I can sell them in the market. Again, equity may not be a good option because equity is generally something that as an investor, you will hold for 5 to 10 years, right? You don't know whether in a year the price might go down. So it's a speculation, right? Normally you wouldn't look at, for an investor, you wouldn't look at equity for a year. If you're a trader, you can trade on a day-to-day basis. You may look at gold, for example, holding gold for a year or so, but again, you don't know the gold value. It keeps going up and down. If you just look at a year as a criteria. So I might look at, FD. Bank FD is relatively safer. I keep with, let's say, nationalized banks like State Bank of India, etc. I feel it's very safe. Or I can put it in Government of India, treasury bills, for example, or in a fund which invests mainly in G-Secs, right? So then that is a safe investment for me. The return on G-Secs is, around for a year is around, I think 5.5% or so right now. If I'm not mistaken, I just looked at it about a week or two back, or maybe let's say 5.5 to 6%. So now how do I equate this 2.75 with 3 and compare, apples to apples or oranges to oranges? Because this is apple, this is orange. I can't compare like that. I have to convert both into apples or convert both into oranges and then compare. So if I invest 2.75 lakhs rupees into, let's say, government securities at 6% interest, I'll get something like, with 6%, I'll get something like, I guess, around 15,000 rupees or something like that by way of interest. And I'm just being approximate here, 2 into 6 is 12,000 plus that will be, something like 3,000-4,000 more. So I'm saying 15,000-16,000 I'll get it. So 2.75 lakh getting today, if I put into G-Secs, it will become approximately 16,000, let's say a year down the line. But the buyer B is giving me 3 lakh rupees, which is more. So 2.75 plus 16 is 2.91 lakhs, whereas this guy is giving me 3 lakhs. So 3 lakhs rupees is a better offer for me, right? The other way around, I can do is, I can say, okay, I'm going to get about 6% on government securities. So I discount this 3 lakh rupees back to today's value, right? Instead of doing compounding and arriving at value of 2.75 lakhs, how much it will be with 6% rate of interest after a year, I can calculate back, 3 lakhs rupees divided by, let's say 1.06, 1 plus 0.06. How much does it mean today if my, discounting factor is dependent on the return on government securities? That might come to, let's say something like 2 lakhs 80 or whatever, right? So then I compare 2 lakhs 80 with 2.75. I say, 3 lakhs rupees a year down the line is a better return for me. This fundamentally is the concept of time value of money. The value of money for me today, if I get 100 rupees, is different if I get that same 100 rupees a year down the line. I will put less value on that 100 rupees down the line as compared to 100 rupees today. Right? If you go and ask somebody and he says, I'll give 3 lakh rupees today, somebody else says 3 lakh rupees after a year, obviously, you will take 3 lakh rupees today and you will settle the deal. Right? I took different amounts of 2.75 and 3 just to illustrate the point. Time value of money means the value of money is for you is dependent on the time at which you pay it or at which you receive it. So the cash flow, when it offers, it matters. The value is not same if the time is different. If you are going to invest in a stock, and let's say that is X amount, in stock A, you are going to get 10 lakh rupees in 10 years. In stock B, you are going to get same 10 lakh rupees after 20 years. Which one you will prefer? You will prefer stock A, which gives you that money earlier, because 10 lakh rupees after 10 years is for you better than 10 lakh rupees after 20 years. So earlier you get the money, you value it more, because you get that money, you can earn something on that. Second, the risk of not getting that money is also disappearing, right? You get the money faster, it is always better. Now, why does it happen? Why is it that the time value of money is higher if you get the same amount today as compared to, let's say, tomorrow or a year or 10 years down the line? 2-3 factors are behind that. As I said, opportunity cost, you can invest that money today, get something on top of that. If you are getting the same amount tomorrow, you are losing that in return, correct? As I said, 1 year you can invest in treasury bonds and get 6%. If you're getting the same amount after a year, you are losing that 6%. So you are losing that opportunity cost. Second is inflation. The inflation is eating into your money. As the same, you must always make your money work hard. If you have got savings with you, your savings must earn more return than inflation. Otherwise, actually, your savings are dwindling. Today, as you know, in last about few months, since basically the world economy has sort of changed with this scenario between Russia, Ukraine, and US and European countries, etc. The war situation, the inflation is very high. I think across the globe, in India also it is inching up a lot. In US it is fairly high. The typical returns on bonds, etc., is near 0%, but the inflation is almost 7.5%, right? So which means that your money is not earning anything, at least if you invest in safe securities, but the inflation is eating into your money, right? It's a very bad situation to have. So inflation is one of the factors which also impacts your decision, because the time value of money is different. A masala dosa, which used to cost me 1 rupees, when I was in college, today I easily end up paying 60 rupees, 80 rupees for that, depending on the hotel where I eat, right? So 60 times. So if somebody was to give me 1 rupee today, versus if somebody was to give me 1 rupee when I was in college, that was more valuable to me, because I could eat one masala dosa, probably a coffee also with that, right? With that 1 rupee. Today, I definitely can't get, even tea, or I may not even get masala dosa with that, right? So that fundamentally, these two factors, the opportunity cost and the inflation also, that is how we think. And then that's why we feel that the money received today is more valuable. And there are some basic, basic common sense things also, right? Money in the bank today is better than getting tomorrow, because you don't know tomorrow. So all that stuff also works. So now that we know that value of the money depends on the time at which we pay and we receive, what is the significance of this? In finance, whenever we take any decisions, right, we usually go with the numbers. We don't take decisions based on emotions or purely on qualitative factors. The emotions matter, qualitative factors matter. I'm not saying that, but in finance, we usually try to work around some numbers and then think on top of that. I think taking decisions only on assumptions, spreadsheets, and numbers is not the right thing to do. Okay. But we always work the numbers, and then on top of it, we, if we may not agree with the numbers, or we may take decision contrary to numbers, but then we need a very solid, qualitative factor beyond that. That's all we understand in finance. So we use this concept in finance to take decisions. Typical finance decisions are, around things like budgeting, planning, allocation, investments, right? So investment decisions are fairly important in finance, taking up new projects, replacing an asset, raising cost, raising funds, looking at their cost, and these are the important financial decisions. Whether to give dividend or not, if you're raising capital, how to raise it, what is the cost of capital, these are all very important decisions in finance. Other important decisions are things like, where to invest. For example, a business, should it acquire another business, at what value should acquire? So valuation of a business, valuation of equity, bonds, all these are also very important decisions in finance. And in all these decisions making, one very important thing we take into account is the time value of money. Same, just the way, I took a simple example of selling a car, right? Or buying something. Same way it works in business. I just took the simple example of an individual for us to identify it. Same way, exactly the same way it works in business. If I acquire a business which is going to give me cash flows, and time value of those cash flows is more as compared to another business that I can acquire, and they are giving certain cash flows, but their time value is less, I'll go for the first one, because the time value of money that I'm going to get from that business, from that investment, is more. This is calculated using something called, cash flows and discounting, right? So that's a technical thing. So we look at the cash flows. Let's say invest 10 lakh rupees in both the businesses, business A and business B, and then I'm going to get so much cash flow from these businesses for, let's say, next 10 years. My decision horizon is, let's say, 10 years. I can't look too much in infinity. Who knows what will happen in business? I say, no, I think 10 years or maybe 5 years is I'm reasonably certain what cash flow they will give me, right? I plot those cash flows and I say, in business A, if I invest, I'm getting so much cash flow. Let's say first year 2 lakhs, then 3 lakhs, 4 lakhs, 10 lakhs, whatever. And in business B, if I invest, I'm going to get so much cash flows. I discount them using my cost of capital. Let's say my cost of capital is 15%. My own funds, they cost me 15%. I'll discount those cash flows by 15%. If I'm going to get 10 lakhs in year 5, I will discount it by 1.15, 1.15, again 1.15, again 1.15 to come back to what it means to me today. And it might mean to me, something like 5 lakh rupees, for example, today. Right? It's like getting 10 lakh after 5 years is like getting 5 lakh rupees today, as an example, right? I'm not doing the exact calculations. Let's understand the concept. So I will do those calculations for business A and business B. And I will say, in business A, I am getting higher discounted cash flow using the concept of time value of money. Money I get after 5 years is less valuable to me today as compared to money that I get in year 4 or year 3. Let's say I get 10 lakh rupees in year 3 and 10 in year 5. This 10 lakh rupees is more valuable to me because I'm getting it earlier in the life of the project. So this concept, as I told you, is extremely important. We should understand the concept very well. We should understand why that concept exists, and we should be able to apply that concept in practice. And the application is simply by way of using the concept of discounting of the cash flows. We use it if we are looking at equity valuation. For example, a lot of formulas about dividend discounting, Gordon formulas, other formulas, the same rate of dividend, growing dividend, or the dividend growing at a certain rate for some time, etc., etc. They all look at dividend in future. They discount it back to the present value. Same goes for, let's say, pricing of the fixed income instrument, right? Bond, for example. What are the cash flows we are going to get in future? Discount them back to the present value using something called yield, what we take as the cost of capital, to arrive at the value of those future cash flows as of today. So even, let's say, we are doing the business valuation, we, let's say, are looking at, we are a private equity fund, we are looking at investing in a revenue stage startup, right? So they are there for 2-3 years, they are making revenue, reasonably predictable cash flows now, reasonably predictable. There's still a risk, but we can project the cash flows, we can look at that, discount it back, saying, okay, this is a revenue stage startup, so it's not as risky as an early stage startup, but still it's a startup. So we'll, take about 22% as a discounting factor. We discount back the next 5 years cash flows and say, no, okay, I think your startup is valued at 40 crores. And we are taking 10 crore, putting in 10 crores, so we need about 25% of equity, right? That's how we look at it. So in these many places, we basically use the concept of time value of money in finance, and therefore understanding this concept, being able to apply this concept is extremely important. So I hope I have been able to explain this concept in simple terms. My goal was not to do the calculations today. We can do the calculations once you understand the concept. Open up the Excel sheet, put up the cash flows for next 5 years, 10 years, take a discounting factor and use the formula, right? So what formula is there? If you are looking at, if I'm putting X money in bank for 5 years and there's a compounding of the interest, then how do I calculate? Principal at the end of, corpus at the end of 5 years, that is C is equal to 1 plus P, that is principal. What I put in first, star 1 plus R raised to N. Now, if I am discounting back, I juxtapose this formula and I say, P, that is the principal as of today is equal to C upon 1 plus R raised to N. So that formula, you can look it up and you can, calculate the time value of money and take the investment decisions. So that's broadly how it works, guys. Do ask me the questions if any. Let me just try to look up how do I look up where the questions are, right? So if there's anything you have joined through Zoom, you can obviously put the questions in a chat box, or what I will do is I'll go through our YouTube channel. I'll just look up whether you have put any questions over here. If you have put up the questions, I'll answer those. Maybe I'll just wait for next few minutes, right? So, and then fundamentally I'll answer those questions. So just waiting for you to ask those questions, right? All right. So I don't see any questions today. So I think we'll call it the end of the session. So thank you very much for joining and for patience listening, right? And all the best to you. If you have any questions on this, please do put it in the in the comment section, and we'll revisit after maybe a few days. And if required, we'll hold another session on the time value of money separately. So thanks for attending today's masterclass from Skillage. We hope to see you next week again, same time, 9:30 p.m. on a Sunday. And that's when for next about a year, we are going to hold a masterclass in finance for you. Correct? So thank you very much and see you. Take care.